Welcome back to the channel. Today, we're diving into the key differences between stocks and bonds. Two fundamental types of assets every investor should understand. Whether you're just starting out or you've been investing for a while, it's crucial to grasp the fundamentals of these investment vehicles. We'll break down the complexities of stocks and bonds, examine their pros and cons, and see how they fit into a balanced portfolio. By the end of this video, you'll have a solid understanding of these essential assets and be better equipped to make informed investment decisions. Let's start with the basics. Ownership. When you buy a stock, you're essentially buying a tiny piece of that company. You become a shareholder, a part owner. Your stake in the company's success or failure is directly tied to the performance of its stock. Now, bonds are a whole different ballgame. When you buy a bond, you're not buying ownership. You're lending money. It could be to a company, a government, you name it. In return for lending your hard-earned cash, they promise to pay you back the principal with interest over a set period. Now, let's talk about everyone's favorite topic, returns. Stocks have the potential for much higher returns than bonds. We're talking about the possibility of your investment multiplying over the long term. But remember, with higher potential returns comes higher risk. The stock market can be volatile. Bonds, on the other hand, are generally considered less risky. They offer more predictable returns in the form of those fixed interest payments I mentioned earlier. Not as exciting as potential stock market windfalls, but hey, slow and steady wins the race, right? Time to dive into the world of trading. Stocks are typically bought and sold on stock exchanges like the New York Stock Exchange or the Nasdaq. It's like a bustling marketplace where buyers and sellers come together to make deals. Imagine a high-energy trading floor with those iconic screens flashing numbers. That's the stock market in action. Bonds, however, are usually traded over the counter, or OTC. It's a bit more decentralized. Think of it like a network of dealers and institutions making deals. Less chaotic, more behind the scenes. Chapter 4: Taxation, Stocks and Bonds. Now let's talk taxes because, well, nobody likes surprises when it comes to the IRS. When you sell stocks for a profit, you'll pay capital gains tax on those sweet returns. And don't forget about dividends. Those are taxed too, typically as income. Bonds, on the other hand, are usually taxed as income. It's essential to remember that tax laws can be complex and vary, so it's always a good idea to consult with a qualified tax advisor for personalized guidance. Chapter 5: Credit Rating, Gauging the Risk of Bonds. When it comes to bonds, there's this thing called a credit rating. Think of it as a report card for the issuer of the bond. Agencies like Standard & Poor's and Moody's Investors Service rate bonds based on the issuer's financial health and their likelihood of repaying the debt. A higher credit rating generally means the bond is considered less risky, while a lower rating indicates a higher risk of default. Basically, it's a way to assess the trustworthiness of the borrower. Chapter 6: Maturity Date. The clock is ticking on bonds. Here's another key difference between stocks and bonds. Maturity dates. Bonds have a set maturity date, kind of like an expiration date. This is when the issuer promises to repay the principal to the lender. Stocks, on the other hand, don't have a maturity date. You can hold on to them for as long as you want, potentially for years or even decades. So, with bonds, you've got a fixed timeline, while stocks offer more flexibility in terms of how long you can hold on to them. Chapter 7: Investing Wisely, Stocks and Bonds. Thanks for watching. If you found this video helpful, don't forget to like and subscribe for more content like this. Remember, understanding the difference between stocks and bonds is crucial for building a solid investment portfolio. Whether you're aiming for growth with stocks or seeking more stable income with bonds, remember to do your research, consider your risk tolerance, and invest wisely. See you in the next one.